Everyone is looking for the perfect time to invest. But what if I told you that the moment is actually right now? The truth is, it's your strategy that is going to build real wealth, not chasing hype, not following the headlines. In a moment, I'm going to show you exactly what to do today, this very second, to set yourself up for life-changing wealth. Now, you might be thinking, is now really the best time to invest? The market's at all-time high. Inflation's sticky. People are talking about an AI bubble, all while Buffett is sitting on record amounts of cash. And let's not forget, we are at valuations that are the highest in history, basically, except for the Great Depression. But here's what most people are missing in that. Warren Buffett once said, the best time to invest is when you have money. This is because history shows that the best time wasn't when you waited. It was when you acted with a plan and stuck with that plan through thick and thin. This video is purely about giving you that plan. I don't care if you're new to our channel or you've been around for a long time. It's really important that you repeat this stuff over and over to yourself. I do this every single day, no matter what I'm investing in. I sit there and remember, Paul, you're in this for 20 or 30 years down the road. You're not in this for tomorrow. We are going to break down how today's market, yes, even at record highs in terms of price, as well as valuation, could still be the best opportunity you'll ever get to build wealth, but only if you follow the right process. I'm going to show you why principle-driven investing beats market timing every single time. How to invest intelligently when prices are high, why understanding the difference between price versus value is the most important skill you're ever going to learn in investing. And you're going to walk away with specific action steps that I will share on how to turn volatility into opportunity. Stick with me, because if you've ever felt unsure about when to invest, what to buy, or how to get started, this could be the most important video you watch this year. So, the question is, Paul, should I wait to invest? Guys, I'm not just saying this like other people do in multi-level marketing. I get asked this question all the time. Paul, you keep saying markets that are all-time highs. You keep saying valuations are insane. Shouldn't I just wait? No, do not wait. Waiting for the perfect time to invest is one of the worst mistakes you can make. Here's the absolute truth. There is no perfect time. There never has been, and there never will be. Because even when stocks are down, it's considerably, your emotions are going to take over. Oh my God, but we have a recession. The nation's shutting down. During the great financial crisis, during COVID, all these times there was always a story why not to invest. It's like saying, in my opinion, I'm going to go to the gym once I'm already in shape. It doesn't work. The same thing happens with investing. I know you're nervous. I'm nervous too at times. And maybe you're thinking, oh geez, the market just keeps going up. What if it crashes? Maybe I should wait until prices drop. I don't blame you at all for thinking that. I have thought that, and I've done that before. But let me be real with you. The people who build true, lasting wealth don't sit on the sidelines. They start, they stay steady, they let time work in their favor. Now, that doesn't mean they're chasing hype. Quite the opposite. They're sticking with a process and a strategy that works. If you waited in 2010 or 2016 or 2020 for things to feel safer, you probably missed out on major gains until you realized it was safe. The market just kept on moving. The people who took action, they made lots of money. Not because they timed it perfectly, but because they actually started. You don't need to be perfect. You don't need to be rich. You just need to start. And I don't care how small you start. Stay consistent. Get that habit going. Invest in the broad markets. If you want to pick individual companies, invest in good companies that are going to last the test of time, and then leave it alone. Guys, personal anecdote. I never check my brokerage account. Even when Merrill Lynch calls me and says, hey, we need you to sign this document, I block out the balances because the market has been up so much lately. I don't want to feel falsely rich. I don't want to make decisions based on where the market's going up or when it goes down, get fearful when it goes down. And I highly encourage everybody who's watching this to do the same. Now guys, waiting does feel smart, but in investing, waiting is actually the most dangerous move you can make. While you're frozen, everything else is moving forward. At some point in everybody's career, they want to time the market. I get it. The idea sounds great. You buy low, you sell high, you ride off into the sunset rich. But here's the problem. It doesn't work. Yeah, it might work once or twice, but it won't work forever. Let me show you why. JP Morgan did a study. It looked at what happened if you missed out on the best days in the stock market over a 20-year period. This was from 2003 to 2022. If you just held on the whole time, your money would have grown by about 9% per year. That's pretty solid. You stayed in, you let the market do its thing, and your wealth grew. But if you only missed the 10 best days, guys, you got to think, there's 250 trading days a year essentially. So over a 20-year period, that's 5,000 days. If you missed the 10 best days of those 5,000, that is 0.2% of the days, your return dropped to about 5% per year. If you missed the 20 best days, you're down to 2%. The 30 best days, you made no money. All your gains were gone. All from missing just 30 days out of 20 years. And I realize how unlikely it is that you'd miss all 30 of the best days because you'd also probably miss the worst days as well. But the point is that when you try to miss the worst days, there's a high likelihood that you're going to miss the best days. Because here's the crazy part. Those best days usually come right after the worst ones, right when the fear is the highest. So if you got scared and pulled your money out, you probably missed the bounce back. And that's where timing the market is a losing game. The people who win are the ones who stay in. They don't panic. They don't try to be perfect. They just stay consistent, which means they buy stocks when things feel scary and buy stock when things are euphoric. They stick to a process. It's not about being smart, guys. It's about being patient. That's the smart money. You don't need to guess the top or the bottom. You just need to be in the market. Time will take advantage of that. Charlie Munger always says, guys, once you've made an investment, get out of the way and let compounding do its job. Now, if you're picking individual companies, yes, you have to pay attention to them, but that's why it's important to pick good companies that have staying power, that are not massively overvalued. So stop trying to time everything. That old saying, time in the market always beats timing the market. Every single time. And in a minute, I'm going to show you what you should do instead and some action steps. But first, let me give you a quick story. Back in 2008, if you remember, the stock market was crashing. The great financial crisis was happening. People thought the financial markets would absolutely shut down. There was fear everywhere. Businesses were laying off tons of people. The world was falling apart. Now, a guy I know named Dave. He wasn't a rich guy, but he was building up his career because remember, in 2008, I'd only been out of college for 5 years. But he was a regular guy working a regular job. He just had learned about investing and thought, this seems like the worst time to buy. And we had a conversation about it. He sat there and said, well, Paul, everything is terrible out there. And I told him, like, yeah, but I'm excited about this. And I have verified proof that I said this to bankers and everything. I always say this in my stories, that the guys at Merrill Lynch and Bank of America always said, you're the only good call we have. So he didn't wait. Instead, and I convinced him this. I go, just put a few $100s each month in to strong companies and index funds. That's all I said. Every single month. Even when the market dropped. And trust me, it was very difficult, especially, but he trusted me. Even when the news was all doom and gloom. And if you remember back then, if you were old enough to remember, it was all doom and gloom. But he kept going. He trusted the process. He believed the market wouldn't stay down forever. I brought up to him, I said, listen, yes, this seems bad, but if you look at history, which he was my age, he wasn't a student of history. I said, listen, in 1929, the market fell 86%. We had depression, people's incomes fell in half, and we still rebounded. In the 1970s, we had inflation with high gas prices. All these things happened. We survived. I said the same things back then that I say now. These bad things all happened, the U.S. got better. I even said to him sarcastically, if you're not willing to invest today, what you're saying is the U.S. doesn't have a bright future. And he kind of laughed at that, but I said, am I wrong? And he's like, yeah, I guess you get your point there. Now, fast forward 10 years. His account has grown a ton, more than he probably thought possible. Not because he picked the perfect stocks, not because he timed the bottom. In fact, he didn't time the bottom. And one of our issues was, as he was buying, he's like, it keeps going lower. I said, and you should root that on. But he stuck with it. And guys, keep in mind, he didn't put enough money in there where if it did go to zero, he would have been destitute. But I just kept telling him, get in the habit of putting money in. He bought things no matter what was going on, when things were at their ugliest. But guess what? On March 9th of 2009, the market snapped back. But we realized it only months later. And when that market did come back, as it always does, he was already riding the wave up. That's the emotional payoff. Dave didn't get lucky. He got consistent. Now, today, he's actually done better than me because he's been in the market for the last 5 years and I've been out. Granted, our situations are different. He needs to invest for the long run because he has a job and he's saving. I've got apartments, I've got businesses. It's okay. Only 30% of my net worth can even be invested in the stock market. So I still have 70% at all times invested in real estate and businesses. So that's why we're a little bit different. But in terms of the market in the last 5 years, he's done very well because the lessons he learned in '08 are paying off today. Now, when we talk, I do tell him like, hey, things are very overpriced. He's like, yeah, I know. I see your videos. And I'm like, just be ready for a bad 10 years. And that's okay. In his mind, he's probably thinking, well, a flat 10 years is way better than seeing the market fall in half over 6 months. And that's what I want you to remember. If now feels like a bad time to start, remember this. The best investors don't wait for good times to buy. They buy when there's blood in the streets. So start where you are. Stick with it. I guarantee rough times won't last, but the results will. Good times don't last forever. Bad times don't last forever. And right now, especially, it's really important to remember that good times will not last forever. The title of this video is about now's the best time to buy. It's not literally meaning that this very second is the best time to buy, but what it means is the best time to get started is now. It's that old saying that we say about everything. When's the best time to start? Right now. Doesn't matter what you're getting involved with. I don't care if you're like, listen, I'm still apprehensive. Get started with something. If you're normally going to save $500 to $1,000 a month, maybe you start with $250 or $300 to get yourself in there. I don't blame you for that. So the question should be, Paul, I get it. I want to stop guessing and I want to start investing immediately. But what should I do? I get that if that's your question. And it's a great question. And I'm going to give you some clear, simple steps. But first, let me show you something even more important. It's not about some trick or magic stock pick. It starts with how you think. Because if your mindset is wrong, nothing else is going to work. There is no magic bullet in investing. It's a mindset that works over a long period of time. Now, guys, I have these 5 tenets of principle-driven investing that myself and our community live by. These 5 rules act like guardrails for us. They keep us from making costly mistakes that destroy most people's portfolio, and here they are. 1, we are investors, not speculators. This one keeps me from chasing the hot stocks, having the FOMO, or trying to time the market based on hyper emotions. I'm not here to gamble. I am here to own real businesses. Number 2, every investment is the present value of all future cash flows. Guys, this reminds me that when I buy something, I have to worry about what's the future going to look like, not the future of a month, 2 months from now. What's this company or what is this ETF going to look like decades from now? Because that's our timeline. If I can pay a reasonable price for it today on an individual company, or have the process where I can over time pay the right price on an ETF, I will do quite well. Number 3, if we don't understand it, we don't invest in it. Guys, this one is going to save you countless times. If you can't explain how a company makes money, you have no idea how it's going to lose money, and therefore no business owning it, period. That's what Warren Buffett was talking about in the late 90s. He said, listen, the internet's brand new. This technology is brand new. I can't possibly determine what these companies are going to look like in 10, 20, 30 years. Therefore, he stays out. And then as time went on and he understood them better, he started to dip his toe in. Number 4, in the short run, stock market's a voting machine. In the long run, it's a weighing machine. Guys, in the short run, any stock is going to do anything. Look at this price chart of NVIDIA. Biggest company, biggest hype story right now. In the last 1 year, it's hit a high of 195 and a low of 86. Are you telling me a company that's worth $4.5 trillion and generates $70 billion in free cash flow, $165 billion in revenue, has really changed by over 50, 60% in 1 year? Come on. That's the voting machine working here. But in the long run, it's the weighing machine. Prime example I always give is Cisco. Cisco, over the long run, this was the voting machine in 2000. This is the company you had to have. This is the NVIDIA back then. Ironically, from this point to this point, the stock is up 10x. Guess what the profit is up? 10x. In the long run, it's a weighing machine. What the fundamentals of the business is going to do will be exactly how the stock works out. I focus on that long run. I focus on what's the business worth. That means I'm going to look stupid right here as people chase price. I'm okay with that. You should be as well. And the 5th and most important tenet, a great story can become a bad investment if you pay the wrong price. Cisco, if you were right here, even if you were right here, Cisco is going to 5x its profit from here to here. Where did the stock go? Nowhere. Why? Because you paid the wrong price. Now, these 5 tenets force me to think logically, not emotionally. When I'm feeling emotional, I go back to them. And that's how you avoid these expensive mistakes that turn investing into gambling. Now, if this makes sense to you, if something just clicked for you, awesome. I'm not telling you have to believe this overnight, but if something says, okay, this is starting to make sense, that's the belief shift moment. That's the point where you stop looking for shortcuts and start thinking like a real investor. And don't worry, I'm going to walk you through some simple steps very shortly. Stick with me. Now, guys, this principle-driven investing and these 5 tenets I just said, they're not something I want you to write down, but it's something that I made for everybody. I have a free PDF, no confusing language, just a simple, clear framework that shows you exactly how to think with these 5 tenets. This is the same framework I use, and I made a cheat sheet for you to make it easy for you to go get it. So when the market goes crazy, when you see a hot stock on TV, or when you start second guessing your plan, this PDF is what brings you back. It's like having me in your ear saying, hey, you're not here to gamble, you're here to build wealth. So here's what you need to do. Go download it by clicking the link in the description. It is 100% free, and if you're serious about investing with purpose and not just playing a guessing game, this is your first step. Keep it on your phone, print it out, tape it to your wall, whatever helps you remember, but go grab the PDF now. You'll thank yourself later. So here are your steps. First step, start with a low-cost index fund. This is the first step to becoming a smart investor. You don't need to find the next big stock. You don't need to read 50 financial books. You definitely don't need to guess what the market's going to do next. Just start with ETFs. An ETF is one of the easiest, smartest, lowest stressed ways to grow your money over time. Guys, I own them. It's how Warren Buffett says you should start. It's how I teach people to get started. And as I wait for stocks to become cheaper, I consistently buy ETFs every single month. It's how you can begin today without needing to be an expert. Here's what it is in simple terms. An ETF is that basket of biggest companies in the market. Instead of buying one stock like Apple or Google, you're buying hundreds of them all at once. It's called diversification. And it's key to staying safe while you grow. And here is the best part. They're low cost. You're not paying some fancy manager a bunch of fees. That means more of your hard-earned money stays investing and keeps compounding. And they're also very easy to find. Most investing apps or brokerages offer ETFs like SPY or VOO. You can buy them just like any stock and hold them for the long run. No guesswork, no stress. That's what I love about ETFs. They remove the pressure. You don't have to pick winners. You just need to stay in the game. So if you're asking, where do I start? That's it. Start small, pick a low-cost index fund, set up automatic investing, and let time do the rest. You're going to look back one day and be glad you made it this simple, because simple works, especially in investing. And if you're ready to get started with ETFs and need a strategy, click this card right here and watch this video. Step number 2, buy great businesses at great prices. So if you're thinking, Paul, ETFs are cool, I want to go deeper. I already have ETFs. I want to learn how to pick individual stocks. More power to you. That's awesome. That means even more so, you're starting to think like a real investor. But here's the most important thing to remember. A great company doesn't always make a great investment. Why? Because our 5th tenet says price matters. You can buy the best business in the world, but if you pay too much for it, your returns are going to suck. You might even lose money. So here's the rule I live by. Buy great businesses at great prices. Guys, let's say there's a lemonade stand in your neighborhood and it makes $1,000 a year in profit. If someone offered to sell it to you for $2,000, is that a pretty good deal? You're going to make your money back in 2 years. How many investments do you know you make all your money back in 2 years and it still keeps spitting off cash forever? Now, what if they ask you $50,000 for the same lemonade stand, $100,000? That sucks. Even though it's the same business, the price has now changed. That changes the entire investment. You have to wait forever to get your money back. Same thing happens in the stock market. A great company like Apple, Google, or Costco might be amazing, and they are amazing companies, but that doesn't mean it's always a great buy. The question isn't just, is it a good business? The question should really be, is the price fair based on what it can return me? Now, don't stress if you don't know how to find that yet. Let me show you the simple steps to finding value. Now, guys, I'm going to go through a quick example here. It's going to be rushed, but it's just to show you what I'm talking about, how to value a company. There will be a video I'll point to you later if you really want to learn how to value businesses, but let's pick a simple company to understand. This very website you're on right now is YouTube, owned by Google. Very simple business to understand. Now, $3 trillion company, generates a ton of cash flow, a ton of profit. I look at these basic things, like my 8 pillars, to say, okay, low debt, buying back shares, cash flows up, revenues up, and net income's up, and they get high returns when they invest money in their business. When they put money into business, high returns come out. That's a good business. Now, I have 2 X's here. These are the PE ratio and the price to free cash flow. Okay, they're X's. Does that mean it's not a good buy? Well, not necessarily. If this company can double its profit every year for 20 years, I would pay 100 times earnings for them. It would be a great deal for me. The question is, how do we put this all together? Well, then I go to analyst estimates to get an idea. Analysts think profit's going to grow 20, 25, 13, 16. So good growth for Google stock in terms of its earnings per share and revenue to grow double digits for the next 5 years. Okay, fine, fair enough. Now, the reason I rush this is because when I'm trying to look for a company, I don't want to dig through everything yet. I want to go right to my stock analyzer tool and say, is it even worth me digging any further? Is it within the realm of possibility for me liking the company? Guys, your time is limited. Don't spend it falling in love with a company that isn't worth it. You will make bad mistakes. So I sit here and I make some assumptions in our stock analyzer tool. And if you're in our community, it'll tell you right here how to use a stock analyzer tool. But here are the assumptions I made last time. I did a 10-year analysis. I did 5, 9, and 13% revenue growth. Low side, 5%, high side, 13. Okay, seems reasonable. Profit margin, I did 26, 29, and 32 because their profit margin is getting better. Now, what's the PE I would attach 10 years from now to the company? Well, it's a great company. It's immersed in our life. It's got a nice moat. If the market average is 15 to 16, it should get a higher PE ratio. So I did 20, 23, and 26. And finally, what's it worth to me today? My desired return, if I want to know what it's worth to me today based on the market return of 9 or 10%, I put in 9 or 10% in here. I hit the analyze button. The stock's currently at 245. Okay. A low price of 170, high price of 470, middle price of 280. So I look at it saying, okay, if my assumptions up there are reasonable, it seems like it's probably worth a little more time to see if I could tighten up those assumptions. That's the point of all of this. I don't want you sitting there breaking down 10Ks and beating up all these. No, just figure out if it's worth more time. That will take you a few minutes. Now, I need to say something really important. The biggest threat to your investing success isn't the day-to-day swings in the market. It is your emotions. Guys, look at Google stock. When it was in the 80s, they were talking about, oh my God, they need to fire the CEO. This thing is dead. AI is going to kill it, blah, blah, blah. Now it's back to 245. The CEO is a genius. News follows the stock price. Guys, I've seen people get ruined because they chased the hype. They panicked during dips, or they bought stocks just because everyone else was talking about them. My buddy earlier, who was buying during 08 and 09, ironically, I had another friend and his wife in 06 who said to me, Paul, we want to invest. And I asked them very clearly, if the market fell 50%, what would you do? And she said to me, well, we'd buy more, right? I said, yes, absolutely. You get it. 2 years later, she did not follow my advice like Dave did. She sat there and she sold everything. And for a second there, she looked right because the market kept falling. But she didn't get back in until all that money had been rebounded and some. She missed out on gains. Now, to be real with you guys, you will see scary headlines. The market will drop. People will say sell now. You are going to feel pressure. You're going to feel fear. You will have FOMO. That's exactly when you need to stay calm and rational. That's when you need to surround yourself by like-minded people who can keep you sane and rational during the tough times. Because smart investors don't chase hype. And guys, when I say staying rational, even now, with markets at all-time highs and all these stocks going up a ton, guys, I just saw a stat that said that the NASDAQ, the companies in the NASDAQ who did the best this year were the ones with no revenue. Think about that for a second. That is not rational. We can be irrational on the way up. We can be irrational on the way down. Smart investors don't chase hype. They focus on long-term value, not the short-term noise. This is where beginners fall off, but not you, because you're already in this video. You know you've got something better. You've got the 5 tenets of principle-driven investing emailed to you. So when things get noisy, go back to this. Remind yourself, I'm not here to gamble. I'm here to build wealth. Now, I believe stocks will be a lot cheaper from a value standpoint at some point in the future. And that's exactly why you need to learn valuation skills today. If you want to make it to the big leagues, you got to learn how to hit a baseball when you're 5, not when you're 22. Think, okay, I'm ready to go to the big leagues. They're going to say, well, hit a ball. Like, oh, I can't. But I'm ready to go to the big league. It's not going to work that way. So in this next video, I'm going to walk you through how we exactly and actually value stocks. That way, when prices swing and everyone else is losing their minds, you will remain calm, you'll remain confident, you'll be prepared to act. The link is right here on your screen, so don't miss it. This is how you get ready for your moment.